All right, so chapter 6, we started a little bit on just the principles, some of the principles, for example, consistency. We talked about materiality, we talked about disclosure. Those are just the grounding for some of the inventory methods as well as other accounting, how we journalize items, how we use different type of methods. We need to continuously keep track of the methods, and if it changes, we need to disclose them in statements. So today we're really getting into the heart of this chapter, which is the inventory costing methods that businesses use in order to assign cost to the sales transactions of the products. Okay, what we mean by this is that inventory, after you purchase it in, it's either entirely not sold out to customer, becomes ending inventory, which is the original inventory asset account, or later on, in the middle of the season, it gets sold out to customer and turns into cost of goods sold expense. Okay, there's only two ways to divide inventory. It's either kept in the business or later on sold out to customer. Okay, so today in this class, you'll be introduced different inventory costing methods. We're really taking care of what to assign, what is the dollar amount assigned to cost of goods sold, and what is the dollar amount assigned to inventory. So last week I briefly mentioned an example. If I own a corporation and I purchase batches of, I'm the manager of purchasing acquisition department, and I purchase batches of inventory at different time point. So ideally, if the dollar amount is the same when I make the purchase, then there's no such an issue of assigning costs. Basically, whichever methods you use, it will be, each and every bottle will be assigned, when we sold out to customer, it will be assigned, let's say, 50 cents. If every time I purchase Coke, I spread out the cost, each and every bottle of Coke worth 50 cents, purchase cost. So that's the ideal case. But in reality, when you purchase the same type of products at different time point, oftentimes the cost may change slightly. So oftentimes if you look back at the purchase cost for different batches along the years, you would see a steady increase of some of the costs for most of the products. Okay, so meaning if January in the beginning I purchased a stack of Coke and I spread out the cost, each and every bottle costs about 50 cents. A month later when I purchase it, probably each and every bottle costs about 51 cents. And then a month later, let's say 52 cents. So when customer comes to purchase these items, these are the same type of product, but what will be the cost that is assigned to that bottle? So for merchandiser and retailer stores, usually it's very costly to trace each and every bottle's original purchase batch, because they are the identical bottles, and oftentimes there are hundreds of transactions that goes on a daily basis. So what businesses do is choose either of these costing methods to just assume that customer is purchasing either from the 50 cents batch, 51 cents batch, or 52 cents batch. Okay, so the idea of first in, first out is whatever was the first transaction of this Coke that happened, the 50 cents batch, we will assume the first customer will purchase the batch of the Coke, purchase the Coke from that batch, so we'll be assigning 50 cents. Last in, first out will be the opposite. The recent cost, we will assume that customer is purchasing from that batch. Okay, average costing is somewhere in the middle, and we'll talk about how to calculate the average cost for these. But basically, the total purchase cost of inventory is the same. What we're trying to do is just use different inventory costing methods to determine what is the cost that we assume customer is purchasing. What is the cost that relates to the product that customer is purchasing now? Whether it's an earlier cost or is it a later cost? Okay. So here it shows just a very basic calculation of ending inventory, cost of goods sold, and you see, assuming that a batch of Coke worth $40 for a couple of bottles, unit cost. So ideally, if this unit cost is the same, and regardless of what methods, basically at the end what you would assign to cost of goods sold and what's left in ending inventory will be exactly the same. Okay, but in some cases and oftentimes these unit cost changes. So even if it's only slightly changed, when you apply different methods, that will arrive at different cost of goods sold amount and later on a different net income amount. Okay, so this is what we're trying to discuss in this chapter. Different inventory costing methods. This will arrive at a different cost of goods sold expense, a different ending inventory. But keep in mind, if you add them together, the total cost available for sale is still the same. So it's just a way how we account for sales transactions, how we capture cost of goods sold expense in each and every transaction. Okay, we'll go into details for each and every method today and also do an exercise on all three methods. So altogether, there's 4 types of methods, but we'll be focusing on the second, third, and fourth. A specific unit cost method is another one that's usually only used for the products that are very high in retail price, or very unique in a sense. So these are different methods, inventory costing methods. Again, they determine cost of goods sold. They determine ending inventory by assigning unit cost to each item sold. Okay, just as this basically summarizes what I just talked about earlier. So when we use first in, first out, earlier cost is assigned to cost of goods sold first. Last in, first out, latest cost is assigned to cost of goods sold first. Okay, we'll go into each and every method in more details. So the first one here is specific unit cost. I'm just going to briefly mention this. We'll not be focusing too much on this because this method here basically just represents for each and every item that you're selling to customer, we actually keep track of its original purchase batch. This is what we call specific unit cost. Okay, this usually is not used for mass-produced products, not used for retail stores, for a lot of the wholesale stores. Okay, it's usually only used for vehicles, for jewelries, for real estate. So you can identify that these are the products that has a higher retail price compared to any of the products that you can see in Walmart or ShopRite in grocery stores. Okay, so for these products, usually there is a specific identification number for each and every, let's say each and every Toyota car or each and every Camry model. So even though it's exactly the same model, the dealer should basically keep track of each and every car's original purchase in price. And then when customer purchased this exact car, they will use the exact purchase price to journalize the transaction. So we don't assume that if customer is purchasing earlier cars or later cars, we actually keep track of the exact product that customer is purchasing from. Okay, so for these products, unlike other products that you see in grocery stores or regular retail stores, they actually keep track of each and every item that's sold out to customer by a specific identification number. Okay, but this process is actually pretty costly to do. So that's why for grocery stores, for regular retail stores, usually we just assume customers purchasing earlier products or later products. We don't exactly keep track of each and every bottle's Coke, whether it's from January 1st batch or March 1st batch. We just assign an inventory costing methods to do this. Okay, but for more expensive products, for these businesses, they actually do keep track of the original purchase cost and use that to journalize an entry when customer purchased that model, that specific car, or that specific type of ring or earrings. Okay, this is called specific identification method. Now for first in, first out, this is the first one that we're focusing on in this chapter. First in, first out, we assume that cost of goods sold is based on oldest purchases, and the oldest purchase batch will turn into customer's hand first, will turn into cost of goods sold expense first. Okay, so going back to that Coke example, if earlier I purchased a batch for each and every Coke, average it out, each bottle worth 50 cents. February 1st, I purchased another batch, each and every bottle worth 51 cents. And March 1st, I purchased another batch that worth 52 cents. If a customer comes to purchase 10 bottles of Coke, I would assume that they're purchasing from the January 1st batch first. So if that batch of Coke, there's, let's say, 1,000 bottle in it, until I sold out the first 1,000 bottle transaction, before that, I would just use 50 cents for each and every bottle. Until it reaches 1,001, then I use the 52 cents to assign that transaction. Okay, so the oldest cost, the 50 cents one, turns into cost of goods sold expense first. So even though in reality perhaps the customer actually is purchasing the one with the within the latest batch that we purchased, we still assume that they're purchasing the oldest cost first. Okay, so on the other hand, since the oldest cost turns into cost of goods sold, the recent cost later on when we count inventory that's in our warehouse still, that becomes ending inventory, which basically is inventory asset that you would see on balance sheet. Okay, so again, if there's 3 purchases transactions that occurred earlier, whenever we start to sell items to customer, first in, first out, we will always assume that customer is purchasing this earlier transaction, earlier inventory first. Okay, so if I purchased 1,000 bottles earlier in January, and then I have another 1,000 bottle in March and February, earlier the cost is 50 cents, and I assume the first 1,000 bottle that I sold out to customer, whenever I make sales transaction, the first 1,000 bottles I will use this 50 cents as the cost. Starting from 1,001, then I will use this 51 cents for the sales transaction of cost. So keep in mind that these inventory methods, it only applies whenever we start selling the products. If we're just purchasing inventory, then we're just accumulating inventory account. We're not using any of these inventory costing methods. So we start to use these methods whenever we start selling the products to customer. So remember in Chapter 5, we talked about a lot of purchase transactions, and then we move on to talk about sales transaction. So the sales transactions is where these inventory costing methods start to apply to the business. Okay, so we assign the cost when we start to sell to customer the first 1,000 bottles. And if a customer comes to purchase 10 more after these transactions, then we assign the 51 cents cost. Okay, so this is first in, first out. Let's take a look at an example here. Okay, this is an inventory record. So this table later on we'll be doing an exercise using this inventory record. You see 3 main columns here. You have the purchases, transactions, purchases, entries, and in the middle, when we start to sell items to customer, we have cost of goods sold expense incurred. Then between the two, the net of the two will be the inventory on hand at the end of the month. Okay, so let's start from July 1st. Let's start from July 1st and assume that in beginning inventory we have 2 sets of DVD players. And each player earlier, our company purchased from the vendor at $40 each. Okay, so you see inventory on hand, July 1st, we have 2 players. Each was purchased earlier at $40. This is the cost that we used up to purchase from our vendor, purchase side of the transaction. So altogether, we have inventory cost $80 now. Okay, so this is the first entry. Now let's say later on we want to purchase 6 more sets of DVD players. And now we notice that the purchase cost that our vendor is offering us is $45 each. So in this case, we'll be adding this information of this 6 sets of DVD players to purchases column. Okay, we have 6 more of the same type of product, but now the purchase cost is $45. So it wasn't the same as what we had earlier in the beginning of July. So the cost of this product inflated a little, increased. Okay, so now altogether we have 2 batches of the same type of product, one at a cost 40, one at a cost 45. All together we have 8 DVD players. Okay. So if we apply first in, first out, now if we want to sell 4 sets of DVD players to customers, can you tell me how should we assign the cost to these transactions? We have 2 sets of DVD players at $40 that was purchased earlier. we had an additional one that was purchased July 5th. Later on, 6 more DVD sets at 45. So if I want to sell 4 sets of DVD players, should I assign them at $40 or $45? $45 for all 4 or just for a couple of them? Just for 2. So the beginning 2 I'll be using $40, and then I will also have 2 of them that I use $45. Okay, why? Because beginning $40, there's only 2 DVD players in stock. So I cannot assign more than 2 because there's only 2 that was purchased earlier at $40. So if I were to sell 4 units, I will assume that customer is choosing 2 from the earlier batch, 2 from the latest batch. First in, first out. Okay? So in this case, I would see 2 assigned at 40, 2 assigned at 45. So if I change this problem to only sell 2 DVD players, then basically I will erase this part. You will only see 2 assigned at $40, that's all. If I were to say that this problem, I'm only selling 2 DVD players, then it will be just the original cost. Because the first inventory that's purchased, I want to assume that customer is purchasing from this batch, and I sell it first. First in, first out to customer's hands. Okay, so after this transaction here, can you tell me how much inventory do we have on hand and how do we assign the cost to this? How much inventory do we have on hand? We still have 4 DVD sets, and how do we assign the cost to those? Would it be 40 or 45? 45. Right? You sold out 2 from earlier batch, 2 from latest batch, so you still have 4 from latest batch, 45. Okay, now the right-hand side, this is just totaling the cost. You use the number of units times the purchase cost. Okay, keep in mind here that this is not retail price. This is not the price that we're selling to our customer. All of these are inventory purchase costs. Okay, this is the first part of the operations cycle, purchase cost. But when we sell it, later on, of course, we will mark up a price as retail price, and the differences between that price and these will be the gross profit. Okay, but this is an inventory record, so all the numbers you see here is purchase cost. The cost that we the cost that we pay to our vendor, and the cost that we're assigning to our customer when we journalize inventory cost transaction. Okay, so we have a beginning inventory transaction, we have a new purchase transaction, there's a sales transaction on cost. Next, if we want to purchase an additional 9 more DVD sets at $47, where do we include this information? The middle, the right, or the left? The left. For purchases transaction, purchases information, we'll be including 9 times 47 in the left column, purchase column. Okay, so this inventory record, you see left side is the new inventory that we get into our warehouse, that we purchase in from our vendor. Middle part, when we start selling it to customer, remember each and every sales transaction you have either cash sales or accounts receivable. First entry and the second entry will always identify cost of goods sold and inventory costs. So for every sales transaction, we have 2 types of transactions to journalize, right? One is with the retail price, one is the cost. This is the cost that you will see in the second transaction. Okay, in Chapter 5, we directly tell you, the problem will directly tell you it's 200 or 1,000. But here we're trying to identify what is recorded in the second transaction as cost of goods sold. If you journalize these events, you will see 170 in the second transaction here. Okay, in the sales transaction, the second one, that accounts for inventory cost. All right, I'm going to ask you to calculate these four numbers, add them together, and tell me what it is. Cost of goods sold, these two, and inventory on hand, these two. If you add them all together, tell me what the number is. Anybody got the answer? Cost of goods sold is 170, and then if you add the right-hand side inventory on hand, what will be the total dollar amount? $773. Okay, let's keep this number. Later I'll tell you what this means. Okay, so this comes from cost of goods sold, and the total ending inventory equals 773. 170 here, and also 603 here. Okay, add them together is 773. Later we'll be comparing this amount with other inventory methods. All right, so as opposed to first in, first out, we have, because before we go into LIFO, this blue shaded journal entry here is what I just mentioned here. So what we're getting from that number, the middle part of this column, the 170, you will see in journal entries, the third one. Okay, the first one here is just purchasing inventory on account. The first transaction that occurred here, 270. And then the middle part, if we start to sell these inventory to customers, then you have the middle two transactions, sales transaction. Okay, first one is the retail price of the product, which is $80 per DVD set. And the middle part, this blue shaded numbers here, is the one that we just identified. Okay, the two of them we sell it at 40, two of them at 45. The inventory costs, we assign 40 to two of them and 45 to the other two. Okay, last transaction here, simply another purchase transaction, and we increase inventory and on account. 9 DVD sets at $47. So what we're trying to get to is the bracket here. How do we assign cost of goods sold? Okay, as opposed to FIFO, LIFO has entirely the opposite concept. So we would assume that the latest purchase batch will turn into customers' hands first. So again, if we go back to this example, we have 3 purchase transactions. And if the first 1,000 bottles that we'll be selling to customer will be choosing from these. We'll be assigning 52 cents per bottle under LIFO method. Okay, last in, first out. Last purchase transactions, we assume if customer purchased Coke, then we will assign the latest cost to those transactions first. Okay, then when it reaches the 1,001 bottle, then again it goes to the second to last transaction, 51. Okay, and then the last part goes to the latest one, the oldest cost. So older cost stays in the warehouse. We assume that older cost oldest cost of the inventory that we purchased earlier, it stays in the warehouse. It turns into ending inventory cost, which again is inventory asset that you see on balance sheet. This is exactly the opposite of FIFO. So last in, first out, latest transaction purchase cost is being assigned to cost of goods sold. Oldest cost stays in the warehouse and being assigned to ending inventory. Okay, if we go back to that exact same example, again, we start from the beginning inventory with 2 DVD sets, each of them at $40. This is exactly the same as FIFO. And then we purchase 6 more at $45 each. Again, this up to this part is still the same as FIFO. We just add the purchase transactions in. Okay, FIFO, LIFO, the inventory costing methods comes to play a role when we start to sell products to customer. So when we are again selling 4 DVD sets in the next transaction, then how would you assign the cost? 4 DVD sets. You will sell the $45 one first, exactly. So we will be choosing 4 DVD sets from the latest batch, assign the cost based on $45. In the middle, you receive 4 times 45, 180. And therefore, ending inventory, we would have 2 from the older purchase transaction, 2 at 40, and then 2 at 45. Okay, we start from 2 at 40. We purchase in 6 at 45. When we start selling 4 DVD sets, we choose from the latest batch to assign the cost at $45. Okay, so you see the middle part, cost of goods sold, 4 at 45. So we have ending inventory 2, assuming that it's from the earlier batch, and then 2 from the latest batch. Okay, now the following transaction, if we purchase an additional 9 sets, and again, this part is just like FIFO. We just increase purchase transaction here in the purchase column, 9 at 45, at 47. So if I add another journal transactions after this, let's say I'm going to sell an additional 5 sets, then which part would you choose from? $47. So if I'm selling an additional 5 sets after this transaction, then again, last in, first out, I will be assigning this 47, the latest transaction, to cost of goods sold expense. Okay. Okay, let's do this last question again. Let's try to add this together with the ending inventory, this total amount here. See what's the number that you got. Cost of goods sold total amount and inventory on hand total. Just the latest column, latest row. Did the number change? Total cost of goods sold expense here and ending inventory, if you add them together, what's the number? It's still 773. Okay, so this tells us what? This tells us that whichever methods you use, the total cost, which is the total inventory purchase cost, is the same. What we're trying to do is just assign whether 45 first or 40 first or 47 first. It's just a way to assign methods, but overall, if you add cost of goods sold with ending inventory, this is what we call total cost available for sale. The 773 is called total cost available for sale. Which basically is adding up the total inventory purchase transactions from earlier. So going back to this, total inventory that you purchased, it's either shifted to customers' hands or it stays in the warehouse. But whichever method you use, the total amount is always the same. Okay, this is what we call total cost available for sale. So in terms of journal transactions, if we compare all the journal transactions that occurred here in the inventory record, if we want to journalize them, the only difference between LIFO and FIFO would be, again, just the blue shaded inventory costing transaction here. The upper purchase transaction, bottom purchase transaction is exactly the same. Sales, the retail price per product, again, is $80, the retail price that you'll be collecting from customer. But how we assign inventory costs is different using LIFO and FIFO. Okay, so remember earlier the bracket shows 2 times 40 plus 2 times 45, and now we have 4 times 45. Because the purchase transaction, the cost was different in each and every purchase entry. So when we assign the cost using different methods, what appears here, 180, is different from earlier what we've seen, 170. Okay, using different costing methods. Okay, now you've seen first in, first out, last in, first out. The last one here is basically an average of the two. Okay, average costing system, the focus would not be on cost of goods sold transaction, but rather on purchases cycle. Okay, meaning that this equation here basically is very simple when we go into inventory record. Basically what we're trying to do is we're not assuming customers either purchasing from earlier ones or later ones, not by the sequence, but every time when we have new purchase inventory transaction, we would do an average cost and figure out what is the average price, let's say, for each and every bottle of Coke. So then when customer purchases it, we just use the average price to assign to those bottles that we sell out to customer. So we no longer, if companies uses this method, they don't assume that customers purchasing from earlier batch or later batch. But if they purchase a second transaction, they will be averaging out these two, find an average number. And if they have a third purchase transaction, then they will be averaging out all three numbers here. Okay, so by averaging, they will total up the cost on inventory and divide it by the total units that they have to find an average cost per product. And they use this average cost per product times the product that they're selling to customer. So later when we look at the cost, the overall cost of goods sold number, average cost would always has a number that's somewhere in the middle of LIFO and FIFO. Because every time it averages out the cost per unit whenever there's new purchase transaction. The bottom note here on this slide is useful for all three methods, not just for average cost. So here I just want to point out that the cost of purchasing goods is the same. This part here, inventory cost, is always the same. We're just trying to divide which part is cost of goods sold, which part is ending inventory. So there will be differences when you look at statements. For companies, if they use FIFO, if they use LIFO, they use average cost, you will see slightly a difference between cost of goods sold numbers for these three methods, and also a difference for ending inventory for all three methods. Okay, this is just a way how we measure inventory cost as we sell, as merchandisers companies sells products to customer, just a way to measure it. So again, ideally the case would be actually tracking each and every bottle, whether it's from the earlier purchase batch or latest purchase batch. But oftentimes, on a daily basis, there are thousands of transactions coming into the company, going out, being purchased, being sold out. So usually this is the way how merchandisers' business measure up the costs when they assign to the products that customers are purchasing. Okay, let's take a look at that example again. Now we start from ending inventory, 2 units at $40, and now we purchase 6 more units at $45. Okay, so for average costing system, the key point here is take a look at all the purchase transactions. Whenever there's new purchase transactions, we will need to average out a unit cost, which is the red number here. Okay, so how we get to this number, we will use earlier ending inventory, the $80, plus the new inventory that you're purchasing in, $270. 80 plus 270 will give you 350. This is the total inventory purchase cost. Okay, once you have the total cost, then just divide it by how many bottles that you have or how many DVD sets that you have. So if this is the total cost of all the DVD sets, we just divide it by 8 to figure out what is the unit DVD cost. So for each DVD set, the unit cost is 43.75. This is the process of averaging out the inventory cost. So when we're now selling 4 DVD sets to customer again, how do we assign the cost here? Not based on earlier, not based on latest, but directly based on this average cost that you just calculated. Okay, when companies use average costing systems, when you start selling the products to customer, then you just use the average cost that you calculated for earlier purchase transactions. Okay, so you'll not be using 40, not using 45, but using 43.75. So after the selling transactions, ending inventory, the same thing. We use this red number here times 4 units because you sold out 4 and you still have 4 left. But both of them will be using the average cost that you calculated to assign the cost to cost of goods sold and inventory. Any questions so far? Okay, what happens if there's new purchase transactions? If new purchase transactions 9 at 47 units here, and whenever there's new purchase transactions for average cost method, you have to calculate a new red number, new average cost for each product. Okay, so this 9 DVD sets, you include it in the left side purchase transaction column. And then we will use this total 423 plus ending inventory 175, total cost divided by total units, 13 units, to figure out a new average cost for each product. Okay, again, what this is, step 1, you always calculate what is the total purchase cost. So you will have a new set of purchase costs, and then you add up what's left in your warehouse earlier before this transaction. So earlier we had $170 left. Now you add in 423. This is the total inventory cost that you have in your warehouse, then divided by the number of items. So you have 13 DVD sets divided by 13. If there's 12, divided by 12. Okay, but basically don't forget to add these two. These are the total costs divided by 13, so each and every unit cost, if you spread out the cost, each and every DVD set costs 46. So this will be the new average cost that you use if later on the company sells an additional transaction. Let's say they sell an additional 5 DVD sets. You'll not be using 43.75, but you'll be using 46. Okay, so next selling transaction, it will be whatever number of sets that you're selling times 46. And then ending inventory would also be subtracting what you sold out, what's left, times 46. Now it's always good to double check that this number has to be somewhere between these two. Okay, if you average out a number that is higher than the larger number, then that basically means there's something wrong when you calculate the average cost. So always make sure that this number, the average method, since it's already called average, it has to be somewhere in the middle of those two numbers, between 43.75 and 47. Okay, let me just go over the step again. For this method, is a little different from LIFO and FIFO. We're not choosing earlier cost or latest cost. Whenever there's new purchase transaction, we would average out, find an average cost for each and every product that we have in our warehouse. So to do this, we will add up original ending inventory plus any new purchases, add the total cost up divided by the total units that you have now, which in this case is 8. So you figure out an average cost per unit. When you start selling the items, you just use that red number to assign the cost to those items, and also use that number for ending inventory. And the key point for this method, again, whenever there's new purchases, you have to do this process all over again. So when there's new purchase transaction, and specifically this dollar amount is very different from this average cost that you just calculated earlier, we do this average cost process again. So you will add up 423 with what you have, 175, and again divided by the total number of sets. Okay, so this will be the new cost. Whenever there is new sales transaction, you will use 46, and ending inventory also 46. Okay, once again, the last step here. Add up this with this. 175 plus 598. If you're quick in calculation by mind, you can probably tell that the number is actually exactly the same as FIFO and LIFO. 175 plus 598, you still have cost available for sale, 773. Okay, so regardless of the methods, what we're trying to do is just divide up the cost between the two, but the total amount is always the same. This was the total purchase cost that occurred before. Okay, journal entries here, all the purchase transactions is the same. Again, when we assign the cost to cost of goods sold to customers' purchases transaction, you see 4 at 43.75. So remember FIFO, 2 of them was at 40, 2 of them at 45. LIFO, all 4 was at $45. Here, average costing, you see a dollar amount, 43.75, which was this part of the transaction. When we first used an average cost, if you have follow-up transactions, then you'll be using 46. But earlier we used 43.75. So this is the part that we journalize in this journal entry. Okay, so for FIFO earlier we had 170. For LIFO we had 180, and here we have 175. So average costing method is always, when we assign the cost, it will be somewhere between the two, between LIFO and FIFO. Any questions? Let's do an exercise in this problem. Okay, I'm going to give out the inventory record. Oh, I'm going to do that later. I'm just going to give out the practice questions too, so later just remember to give it back to me. Here we go. Okay, if you take a look at this problem here, the first table you see all the transactions that occurred in November for this company. So the first 3 transactions is all related to inventory purchases. So the relationship between your company and vendor and suppliers. You have 1 gallon of milk purchased at $2 each, 2 gallons at $2.10, 2 gallons at $2.20 at different time point. Okay, so for this inventory record here, you see FIFO, LIFO, and average cost. You see exactly three exact tables. But using different inventory methods, you should be getting a different cost of goods sold expense, different ending inventory. Okay, so just fill in the numbers, the information for purchases. I already filled in one for you. You see November 2nd, 1 at $2. Then just continue that information. November 6th, November 13th. And when it reaches November 14th, when you're selling 4 gallons, try to apply these rules. Okay, when it comes to selling, how do you assign the cost for those 4 gallons? let's take a look at how to complete this inventory record. So if we use, first of all, the first method, first in, first out, the upper table tells you that there's 4 transactions that happened in the company. 3 of them relates to purchase transaction, 1 of them is selling. Okay, so under first in, first out, the theory is first purchases entries, we assume customer is purchasing from earlier transactions first and then later ones. So if we're selling 4 gallons of milk to a customer, from all these 3 purchase transactions, where do you choose from first? $2 first for 1 gallon, and then you have $2 from the second, 2 more gallons from the second transaction. Since you're selling 4 gallons, you have an additional 1 from this last transaction. So meaning at the end you still have 1 gallon left at the recent cost. But all the earlier ones, you already sell it out to customer on November 14th when you sell the 4 gallons. You'll be choosing this first, and then another one from the last transaction. Okay, so the record here, the table shows is from top to bottom because the slide doesn't have enough space. So the first 3 transactions basically is all related to purchases. Okay, November 2nd, you have the original, you have the first purchase entry. November 6th, you have the second purchase entry. And the blue shaded ones, the blue shaded is total inventory on hand. Okay, total inventory on hand basically just accumulates those 2. 1 gallon at $2, 2 gallons at $2.10. Okay, now following up, if you purchase an additional transaction, purchase an additional batch of inventory on November 13th. So again, the blue shaded ones, inventory on hand, you will have 3 transactions listed together in a column. Okay, blue ones is total inventory. Now when it reaches this point, the following transaction, the last one is selling 4 gallons. So selling 4 gallons, this part here is cost of goods sold, the middle part of the table. Cost of goods sold, you will be using 1 at $2, 2 at $2.10, and the last one at $2.20. Okay, so this is the total cost of goods sold in the middle. Okay, the first 2 lines, the first 3 yellow lines here goes into purchase transactions, first 3. Blue one, the right side, inventory on hand. Second blue shaded column, second blue shaded row, also inventory on hand. Okay, this part here tells you sold, basically is cost of goods sold expense. Okay, you're selling 4 of them and you're choosing from first, second, and the last one only 1. So meaning at the end, ending inventory, you'll only have this at the end. The balance line at the end, ending balance, right-hand side, you'll put down 1 gallon at $2.20. So this is the total ending inventory. Yes. At the end, after all 4 transactions, there's only 1 gallon left. Okay? So basically, you will see the balance, the blue one here, under November 6th, the right-hand side column, you will squeeze those 2 transactions together on ending inventory. And these 3, you will see under November 13th, the right-hand side ending inventory. You have 3 purchase transactions altogether up to that point. Okay, but after November 14th, the middle part, you sold out 4 gallons. So then at the end, you only have 1 gallon left. Okay, so total inventory balance will be $2.20 at the end of FIFO. Total cost of goods sold will be how much? Total cost of goods sold, you sold 1 gallon at $2. The inventory, 2 gallons at $2.10, 1 gallon at $2.20. So you would add up 2, 420, 220. Altogether you will have $8.40 for FIFO cost of goods sold. Okay, so ending balance, you see cost of goods sold expense $840. Ending inventory that's in the warehouse in your company, $220. Okay, so total cost available for sale altogether is $1060. This is just additional information. You don't have to fill this out anywhere. Okay, but you will see these two at the last line, ending balance. This is for cost of goods sold expense. This is for ending inventory. Okay, let's move on to LIFO. LIFO, the first purchase transaction, again, is the same. Second transaction, you add in November 6th, also purchased 2 gallons, 210. So first two, again, appears here, purchases, the first two yellow rows here, and then the blue shaded one, ending inventory after this transaction. November 6th, you will see ending inventory on the right side, squeezing those two lines, transactions. Okay, November 13th, there's an additional purchase transaction, so you add that line to purchase column. And then the right side, ending inventory, you add another transaction. So up to this point, the total ending inventory, you have 3 different batches of transactions of milk. Okay, now again, when it reaches selling 4 gallons, since this is last in, first out, you'll be choosing from the latest transaction first, then to the middle one, and then the last is the upper one. But since we're only selling 4 gallons, so 2 will be choose from recent, 2 from the middle transaction. Okay, so for cost of goods sold, this goes into the middle column. Cost of goods sold, you'll be choosing 2 by the latest cost, 2 by the recent cost. 2 by the recent cost, 2 by the middle transaction, 210. Okay, so this is the total cost of goods sold expense, $860 under LIFO. So on the last line, the balance for cost of goods sold expense, you have this, adding the 2 transactions up. So this is the part of cost of goods sold, and ending inventory will be the oldest cost. The 1 gallon that you have left, we will assume that is from the oldest batch, so it will be $2. So again, total cost available per sale is $1060. We're just trying to divide up what cost belongs to cost of goods sold, what is the cost of ending inventory. Cost of goods sold is basically these two numbers. Add them up. Okay, so this middle part here is sold 4 gallons. This goes into the middle column, cost of goods sold. Now this record here is also on Blackboard. This inventory record you can also find in under course documents, Blackboard. Want to do the practice again, or this weekend there's homework on this also, similar to this record. Okay, it's just you'll be doing it on my lab. But if you want to do another practice again, you can download it from Blackboard. Okay, any questions so far? I know this may seem a little confusing because it's not the same as what you have on hand, right? So any questions on understanding the numbers? Basically, all the yellow ones, November 2nd, 6th, 13, goes under purchases. Blue shaded ones, the first 2 blue shaded goes under ending inventory after purchases. You're just accumulating what you have in the warehouse. Okay, this part here, when it comes to selling, that's the part we apply LIFO, FIFO, that goes into middle, cost of goods sold expense. And then ending balance, you have 1 ending inventory. So at the end of this, the very last line, ending balance, you see 1 appear at $2, okay, for ending inventory. All right, now the last one here for average costs. Again, average cost, the key point when we want to average them out. Every time there's a new purchase transaction, you'll have to do this average process again. Okay, so beginning transaction, you have November 2nd, second transaction, November 6th. We want to find an average cost right after this second transaction. So you don't know when you'll be selling the item to customer. Even though this problem gives you all the transactions, you know after the fact that we only sell it after 3 transactions. But when it's at the time point November 6th, you don't know, probably tomorrow you'll be selling a few gallons of milk. So you always average out the cost every time there's a new purchase transaction. Okay, so this part here, we added the total cost for these, which is $6.20, divided by, so far up to November 6th, there's only 3 gallons of milk. Okay, so total up $6.20 divided by 3. Unit cost is 2.0667. It can go on. You can round it up to 2.06 or 2.067 or 2.07, either way. Okay, so this part here is the average cost. Again, blue shaded one goes into ending inventory. Okay, the right column you see 3. Unit cost 2.0667. Now, next transaction is also a purchase transaction. So we average out, find a new unit cost again. So new purchase transaction, we have 2 more gallons at $2.20. The total cost additional to what's there above is $4.40. So you'll be adding $6.20 plus $4.40, then total divided by 5 gallons after this purchase transaction. Okay, again, every time there's a new purchase transaction, we find a new average cost. And that will be used when we start selling these gallons of milk, we'll be using that average cost, the recent one. Okay, so the new cost here is $2.12 after November 13th purchase transaction.
That's only when you purchase. How about if you sell it at the inventory? Do you calculate the average cost?
So when we sell it, which is the following transaction, right? When we start selling it, we'll be using the recent new average cost, $2.12. So if we sell something in the middle between November 6th and 13th, we'll be using 2.07. Okay, so before this transaction, this was the average cost. If we sell 1 gallon immediately tomorrow after this, November 7th, then we'll be using 2.07. So we only average it out whenever there's new purchase transaction, and then when we sell it, we just use what we calculated earlier. Okay? So this case here, we sell 4 gallons at this cost because we didn't make any sales transaction between those 2 dates. Okay, so this is the latest average cost that we got. We'll be using this when we sell it. Okay? Okay, and this cost would also be used for ending inventory. So average cost, the key point is whether you can get a new average cost. Then when it comes to sales, you basically just use that number, and you also use that number for ending inventory. So the unit cost, you just use the unit cost times the units that you're selling to customer, or times ending inventory. That will be the total ending cost or total cost of goods sold. Okay, so this line here, 212 times 4 units, 848 will be the total cost of goods sold, and then 212 will be ending inventory level. So these two again, cost of goods sold, cost of goods available for sale is also $10.60. It's exactly the same regardless of the methods that you use. So if there's following up transactions after this, if we're selling that 1 gallon out, then we'll be using the 212. But if we're making new purchases of different gallons of milk in the next month, then whenever we make new purchase transaction, you'll be averaging out the cost again. So using the total cost of new inventory plus what's left in the warehouse, then divided by the new numbers of gallons. So you'll find a new average cost every time there's a new purchase transaction. Any questions? Okay, here's a table that just compares all three methods. So under FIFO, units sold includes the oldest costs. We always start from earlier transactions, then to later ones. And therefore, if the unit sold is oldest, what's left will be the newest cost. Okay, LIFO will be exactly the opposite. Units sold, we start from recent cost. So ending inventory included on balance sheet will be the older costs. Okay, average cost is always, we're constantly averaging out a unit cost, so the numbers is not from the oldest or newest, it's actually somewhere in the middle. So you see this number is in the middle of these two. This number, the value is also in the middle of these two. You know, some of the benefits of using these methods, if FIFO has the oldest cost for a cost of goods sold expense, and in the case that the purchase prices in different transactions is constantly rising, probably just incrementally a little bit, under this case, if we use FIFO, always cost of goods sold expense is the oldest, which means is the least, and this at the end will lead to a higher net income amount. Okay, if expense is the least, oldest cost, and in case there is inflation, the cost is constantly rising, then using FIFO method compared to companies that uses LIFO, you will have a higher net income amount. Okay, so this is an example. If we're making sales using all three different costing methods, sales transactions, let's say the retail price is $3.20 for all three cases. If we use different methods, if we use cost of goods sold expense using FIFO method, you will see cost of goods sold expense is the least for FIFO and the highest for LIFO, because in the case of rising prices, LIFO always picks the highest cost first. FIFO picks the least earlier cost first. Okay, so this will lead to a different amount of gross profit. Under FIFO, you see that since cost is the least, gross profit will be the highest. Under LIFO, since cost is the highest, gross profit will be the least. Okay, average cost is always somewhere in the middle of those two. So there are some of the advantages that leads corporations sometimes to want to use a specific type of method. All three methods are allowed under GAAP, and they're generally accepted accounting principles. Okay, but the advantage for using FIFO is that you seem to have a higher gross profits showed on the statements. Okay, so this could likely attract more investors. You may have a better borrow terms if you want to borrow money from creditors. Under LIFO, the advantage is that since gross profit is the least, when it comes to taxes, you will also be paying the least taxes compared to using FIFO. So in the case that this season, if a company wants to reserve or conserve some of the cash in this season, if they think their operations is more tight, they may decide to use LIFO in terms of inventory costing to save some money. Okay, so there are benefits for using these different methods here. First in, first out, higher income attracts more investors just by financial statements. Last in, first out, you pay lower taxes because you show lower income. And average cost is always somewhere in the middle. Okay, but in practice, this method is used more. About half of the corporation uses this, about 46%. Second one is this, and then is this. Okay, first in, first out, last in, first out average cost.
Doesn't price distribution increase though? So wouldn't LIFO lose like a higher gross profit, therefore pay more taxes?
In terms of when purchase cost is increasing,
Yeah.
it will be the opposite of that. Because if purchase cost is increasing, so you'll be selling, you'll assume that customer's purchasing this first, right, under LIFO, last in, first out. So this turns into a cost of goods sold expense, and expense is subtracted from revenue, so you will have a lower revenue under this. Right, so this is what I'm showing here. Under LIFO, the total expense will be higher compared to FIFO, 170. LIFO, you have 180 because you're assuming customer is purchasing from the latest batch. Okay, but this is the case when prices is rising. If the case all the prices are the same, then it doesn't matter which method you're using. Okay?